All right. Good evening. We're a couple of minutes late here, but thank you so much for joining. Now, I've not done a live stream in a while, actually. So this is a little peculiar for me because I used to do these regularly all the time, and obviously since my move, it's been a little bit difficult. But anyway, you're probably tuning into this because this week has been hella crazy with Trump, the markets, and so I have someone with me who actually works in the investment industry. He's an investment manager himself, and we're just going to talk about what's happened over the past week or so, what he's seeing on the professional side, and maybe how he's approaching it, how his clients are approaching it. And hopefully, in this, there'll be some nuggets that you can actually take away from this as well. And I think what we'll do is we'll also open up for questions once more people join. But this will be saved on the channel as a conversation piece. So, Jax, welcome, mate.
Pete, it is so good to see you. Yeah, I didn't actually know you were moving away from the UK. I just happened to come across one of your videos, and I was like, hey, he's made the move. He's one of the guys who's made the
Yeah.
move. But well done, well done.
Oh, cheers, man. No, I appreciate it. I appreciate
Yeah,
it.
but
Bit
I'm
of a
good.
change, but there we go.
Yeah. I'm good. So yeah, I was telling you just off cam that I had a month off because I had a surgery and I've gone back into work, and I've just gone back into chaos because of what's
Man,
happening within the
yeah,
financial market. So yeah, we could chop it up. I myself need to get my head fully around what's going on. But of course, in the profession, we are taking steps and reacting to what's happening across the globe.
yeah. Okay, okay. So to start this off, why don't you just give a bit of an introduction so that everyone who's watching will kind of get an idea of your background and what you do? Because when I say investment manager, I'm not sure that a lot of people will understand exactly what that is.
Yeah. Well, the clue is in its name. So my name is Jax Opoku, and I have been in the industry of investment management, asset management for about 10 years now. Um, I started off in a back office, working as an operations assistant, operations analyst, and I kind of worked my way up. So in terms of academia, I studied economics at university, Loughborough University. Then I did a master's in financial economics, which made my dad very happy, obviously. And then look, I'll be honest, if I didn't really know what I wanted to do. I just knew I enjoyed economics and it was interesting. It's a very new subject to me, growing up in the kind of environment that I grew up. And I kind of fell into investment management in the back office. And as I said, did some professional qualifications such as the investment management certificate. And yeah, just worked my way up from investment assistant to fund manager assistant, and now working as an investment manager. But if I'm really honest, the role is still kind of an assistant investment manager because we do have CIOs and the
Yeah,
big the
yeah,
big dogs who make the big decisions. And a big part of
yeah.
my role is making sure that all the clients that we look after on my desk, we make sure that their mandates and their portfolios, mostly multi-asset portfolios,
Hmm.
are very much in line with the client's mandate and in
Hmm.
line with the house view as well, which has obviously changed in recent times, which
Massively.
has made me a very busy person. But that's me in a
Yeah.
nutshell.
Okay. So let's jump straight into it. So you've obviously you had a surgery, you got back, and all of a sudden markets have gone AWOL. What kind of things are you seeing at the minute
Yeah.
coming across your desk? Because I know that every single day you'll get a lot of information, data through around what's going on, how you're going to structure these portfolios. What are you seeing at the moment? And I'll probably ask you a little bit later on that around this whole tariff war thing.
Yeah, yeah.
I mean,
I mean, do you know what's interesting, Pete, is when as I'm having conversations with different people, I always tell people we actually need to go a bit further back before we look at what's happening right now.
mm,
I mean, if we look at even Trump and his ideologies, it's always been there. It's only
yeah,
really coming to fruition now. But also in the stock market, I got very lucky in terms of my own portfolio, where
hmm,
I de-risked quite a lot coming into 2025. And a big part of that was because I looked at the market. I say I looked. I'm fortunate enough to have a lot of information, right? So
yeah,
the market was quite frothy, right? It was quite, I'll call it overvalued.
hmm, hmm,
And in other words, I would say there was a lot of risk in the stock market, right? A simple example would be how much debt there is in the US, for example,
yeah,
right? So there was already a lot of risk aside from tariffs. And I
Mm-hmm.
know, and I've played this game many times for many years. When the market is overvalued, it takes one piece of information and it really just comes tanking down. So
Yeah.
on a personal level, I actually de-risked my portfolio quite significantly coming into 2025. And also, again, history is a great teacher. It doesn't always repeat itself, but it does rhyme, and it rhymes
Mm-hmm.
quite well. So almost every time we've had a 2 year outsized return, which we have had over the past 2 years, the next year is almost always a negative year,
Mm-hmm.
right? So with that in mind, again, coupling that with my personal objectives, my own risk appetite, my own way of investing. And when you first met me, I was in my 20s. I was a
Mm-hmm.
young man. I was investing in high growth stocks. I didn't mind if those companies were not profitable. I didn't mind. I was all about growth,
Mm-hmm.
growth, growth. But now I'm in my mid 30s. I'm going to be 35 this year.
Mm-hmm.
I'm a
You're
married
married.
man, with a
Yeah.
mortgage. So I can't go
Yeah.
and tell my wife that I lost 10 grand on a
Yeah.
speculative name, right? So my
Yeah.
investment strategy, my risk tolerance, my capacity for loss has all kind of changed. And that means, every so often I do adjust my portfolio, or in other words, rebalance my portfolio so that it
Mm-hmm.
actually still meets my objectives, my time frame, and my risk tolerance. Anyway, going back, I've gone a bit off tangent, but going back to your original question, yeah, we are seeing a lot of things come through, and you don't need to be in the industry to actually see what's happening. There's a lot of information out there. We know what Trump has done on Liberation Day. We know how the stock market reacted to that. We also know how the bond market reacted to that. And the bond market is a
Mm-hmm.
very important market to pay attention to. We've seen yields pick up, which means prices are going down, which is not always a great thing. It's not often not a good thing. Um, we've seen when he mentioned the fact that he's paused for 90 days and he's open for negotiation as the stock market popped back up, right?
Yeah.
So before we even talk about the pop back up, in terms of going down, I think it was the biggest drop since we've
Yeah.
experienced since the pandemic.
Yeah.
And then the pop back up as well was the biggest.
It was 7% on the S&P 500. I was looking at it, and
Absolutely,
like I think it was the Dow Jones was up like something like 2,000 points,
yeah,
literally on the bounce of that news. It was
it
incredible to
was
watch.
nuts. It was nuts. And the Nasdaq even higher, of course, is a more
Yeah.
volatile index. So there is a lot of information coming in the sense that there is not enough information. There's enough information to tell us there's not enough information, which is
Hmm.
there's a lot of uncertainty. And we know the one thing the stock market does not like is
It's
uncertainty.
uncertainty. Yeah.
And we've reacted to that on our desk.
Yeah. So getting into the whole trade thing, I think a lot of people are kind of taking the stance, or at least they're of the opinion, and especially some of the more prominent economists around the approach that he's taken towards trying to shift global trade in this way. I mean, I think it's to be expected. It's Trump. So there's a little bit of ego. He kind of said he was going to do it. I don't think anyone thought he was actually going to do it in the way that he has. So should we really be shocked? Maybe not, at least. But in the practicalities of it, there are lots of arguments and people saying, well, actually, if he's looking to reshore manufacturing in the US, that in itself is a huge problem because of the investment he's going to require to get all the factories in, the upskilling, um, just thinking about the cost to actually run those things. And then you start talking about AI and automation and how many jobs it's actually going to bring back. And the big thing in this is China. And as you probably heard today, they've retaliated with 125% tariffs. He's now put 145% tariffs on. I mean, that's probably their biggest competitor, their biggest worry in this whole equation. And the question is, there is no off ramp.
Yeah.
So how are you seeing that from the investment side in terms of, okay, he's paused for 90 days for everyone else who now wants to negotiate, but China's not backing down, it doesn't seem.
Yeah. I think what I know is as much as you would know. I think we've all just come to the agreement and the understanding that we don't know what this guy's going to do.
Mm,
Now it's very difficult, as you said. We knew he could do something. I had a feeling he would do something, which is why I de-risked. I didn't know he would do it in this nature. However, and this is me talking from my own opinion, I did have a feeling that he's being quite strategic in what he's doing in terms of playing it in such a way where he knew that people will come and want to negotiate. And this is again, and this is just my opinion, and something we probably would want to speak of air. But I would
Mm-hmm.
say that I think he just wants to have a legacy of being known as the master negotiator.
Mm-hmm.
Um,
Mm-hmm.
and also, I think he also wants to showcase that he's he's, how do I put this? He's going to get it done no matter what, kind of
Mm.
thing. But yeah, no, in terms of what he's going to do next, we're not sure. I think there is a bigger conversation to be had, a much longer winded conversation to be had about global strength when it comes to China versus the US, and whether really this is all about just China versus US and being the number one, I call it the number one gang,
Mm-hmm.
right? I say
Yeah.
that because of my
Yeah.
background. Um, we will see, but I don't think anyone really knows what's going to happen, and that
Yeah.
creates a lot of turmoil and volatility in the markets.
There is a theory around the American debt and the fact that some of it needs to be refinanced in June. I think about $9 trillion worth or so. And the theory is by taking this course, you get the markets to correct, you get the dollar to correct, and the opinion is, or at least the theory is, at least, so they go by the Mar-a-Lago Accords, that if they can get the 10-year yield down, it will give them the ability to be able to negotiate with partners who have debt to help restructure.
Yeah.
I what are your thoughts on that? I know this isn't
Yeah.
exclusively investment management, but it's kind of like one
Yeah.
of those things
It's
where it's kind of one of those things that you could say, okay, it could be plausible, but at
yeah,
what
we don't,
cost?
at what cost. And the fascinating thing about economics is a science. It's a science, but it's also an art, and no one really knows what actually would work, right? The whole study of economics is about infinite wants and scarce resources, right? It's trying to find the
Hmm.
best optimization, and we don't actually know how people behave and how people react and how the stock market is going to fully react. Now, I wouldn't be surprised if that was his strategy. He's very strategic and tactical, and I think we can't put anything behind him.
Hmm.
And this is me just being a bit, what's the conspiracies or whatever. I wouldn't be surprised if like he always knew what he was doing, and he's just being strategic and playing the game kind of thing.
Yeah.
But again, yes, in terms of devaluing the dollar, in terms of refinancing, yeah, won't be surprised. I mean, the whole idea of tariffs is to bring in tax receipts, right? Apart from the whole everyone is bumping us and everyone is cheating us, and we're trying to be
Hmm.
more fair. Maybe it's that as well. I don't know. I don't know. I don't think anyone really knows what he's trying to achieve, apart from the fact that he's saying that it's been unfair and he's going to create. It's a form of protectionism, isn't it? Kind of
Yeah,
thing.
absolutely. Yeah.
But no one knows.
Yeah.
No one knows.
On on the investment side, then you said this year you came into this year, you kind of de-risk your portfolio quite a bit. Obviously, I agree with you 100%. We were at a junction for it feels like for a long time where there's so much money just flowing, and really there is nowhere else for it to go but America,
Yeah.
S&P 500 being one of the leading indexes. And it's like, okay, so at what point do we see this kind of like correction and
Yeah.
stuff? So
Yeah.
you were de-risking your portfolios, and you
Yeah.
talked a little bit about the stuff that I love talking about, which is the boring stuff: attitude to risk, capacity for loss, your goals, your timeline, all that kind of stuff. What was the main kind of like driver? You see, obviously your circumstances have changed and stuff like that. Was there anything else that kind of made you think, okay, right, maybe I do take some risk off the table? Because I think in time moments like this, you're more likely inclined to now actually go put some more money on the table
Yeah.
because you're at more favorable pricing.
Prices.
And I
Yes.
just want to get a sense of your thinking around that for people who will be watching this. Because I've been
Yeah.
saying that, this is an opportunity. Yes, it looks horrible when you're
Yeah.
looking at a heat map and it's all red, but actually, in the scheme of things, if you're looking at investing and doing it properly, this is a huge opportunity to be able to get into the markets at lower prices so that you can actually get some growth on the upside.
Yeah. So trying to gather my thoughts, there was many reasons why. So you look at a macroeconomic environment, and again, this is a much longer conversation that we can fit into
Hmm.
one episode. But again, you look at the macroeconomic environment, you look at the debt levels, you look at whether we were going to have a soft landing, you look at the whole potential of tariffs and it being potentially inflationary. One of the things that I'm scared of the most as an investor is stagflation, right?
Hmm.
That's one thing that I don't like, and I don't think any investor should like, right? And I
Yeah.
think the risks of stagflation were ever so present. And for me, that was too much of a risk for my portfolio. Inflation is not good for most assets because of usually the response. Bonds
Yeah.
hate inflation, they hate inflation, but higher interest rates again is an issue for risk assets. So
Hmm.
it was mainly those reasons where I felt as if stagflation could be a real thing this year. And in that kind of environment, I don't want the majority of my assets to be risk assets. And so now the key thing for me to clarify is that it doesn't mean that I sold everything and I went into cash. No, you want to remain at least somewhat invested. And I think what's really, really important for retail investors to truthfully understand that the boring things that you've mentioned is boring, but it's the most important thing when it comes to investing.
Hmm.
It is and I think even investment managers and the people that get paid the big bucks and all that kind of stuff, the one thing that they really do, I say we really do ultimately is risk management. That's what it really is.
Yeah.
It's being able to build a portfolio, the most optimized portfolio, using as much information and tools as possible that matches the mandate or the portfolio's objective, time frame, risk tolerance. And so
Yeah.
I always encourage people to always review their portfolio and try and optimize across these three things. It's difficult for some people to do, which is why multi-asset funds are also good, right? Because they'll have
Hmm.
cautious, balanced, and adventurous.
Yeah.
Um, but and for people that I coach people one to one sometimes, and one of the things I often tell them to do, P, is I say, look, every quarter, half year, whatever time period you choose, just look at your portfolio, close your eyes, and imagine it dropping by 30%. So, and I often tell people actually the math is easy. Just multiply it by 0.7, wherever the value is today, and then look at that number. If it doesn't make you feel good or you start to feel some funny feelings in your stomach,
Hmm.
then you are over invested and your portfolio does not actually match your objectives, time frames, and risk. And it
Hmm.
may have initially, however, and this is the whole point of rebalancing. If the stock market goes up as it did over the past 2 years because of various reasons, but really and truly, let's be honest, it's because of AI,
Hmm.
and the excitement around AI and the Magnificent Seven or Eight, whatever
Hmm.
you want to call it.
Yeah.
Then you really want to reassess whether you want to rebalance, maybe take some profit, go into a bit of cash, maybe add some bonds to your portfolio. And so, yeah, to answer your question, it was for the fear of stagflation was the main reason why I de-risked my portfolio amongst my own personal
Yeah.
circumstance, which is in line with what I'm saying because your objectives, my time frame, my risk
Yeah. Yeah.
tolerance, you have to assess it.
Yeah. So you mentioned some really important things there. You mentioned things around the portfolio, building a portfolio that matches your your time frame and your goals and all of that kind of good stuff. But I feel like for normal people who perhaps are approaching investing for maybe the first time or just getting started investing, it's very, very difficult for them to be able to build a portfolio of their own,
Yeah.
particularly when a lot of the options that they have available to them. And again, this is where you can get into the conversation about cost and providers and who you should choose. And oftentimes the mantra is keep it low cost,
Mhm.
which is a just one for sure. But for a lot of investors, what I've seen over the past 5 years of doing this is the initial route is straight into an ETF, S&P 500, which is 100% equities.
Okay.
And I say, like, obviously, it's a good place to start, which is fantastic, but it doesn't include those other asset classes. So when
Yeah.
you talk about multi assets, it's because it's going to have, yeah, it's going to have the equities in there, but it's also going to have a footing in bonds, maybe a footing in commercial property. Then maybe you might have a little bit of gold or
Yes.
commodities and those kind of things.
Yes.
I find the construction of those kind of portfolios for ordinary people can be a little bit difficult. Can be a little bit difficult to do because of the options they have. If they go with Vanguard, it's all ETFs
Mm.
predominantly that most people will go for, and they don't necessarily know how to construct that. What
Yeah.
would be your words of kind of like advice for that?
Yeah, you're absolutely right, and like, probably more so this year than not. I've been quite intentional with letting people that I speak to understand that it's not just about the S&P 500. You're gonna find a lot of finfluencers say just invest in the S&P 500, and that's the way to go. And that's not bad advice. It's just incomplete. And the
Hmm.
reason behind that is because having an all equity portfolio, particularly the S&P 500, um, means you are exposed to just equities, as you've just said,
Hmm.
but also you're just exposed to the US region.
Yeah.
And actually, if you dive even deeper, the S&P 500 really is about 30% Magnificent Seven, right?
Yeah.
It's really small
Exactly.
companies.
Exactly.
Um,
Exactly. Yeah.
so, and I say to people, okay, we're having a conversation. Let's talk about your objectives. What's your risk appetite? Okay. Choose a risk appetite between 1 and 7, with 7 being the most risky and 1 being the least risky. And they will tell me, oh, 4, kind of in the middle. That's fantastic. So what you invested in again? Oh, S&P ETF FUSA or something. I said, well, fair enough. Let's go
When
and
you
look
go
at
look at it, it's like a
it.
six. It's like a 6 out of 7. Yeah.
Right.
Yeah. Yeah.
So actually, you have not invested in a portfolio that matches your risk
Matches.
tolerance.
Yeah.
And what's going to happen? It means when you need the money, you might be selling it at an inopportune time,
Hmm.
which means because it's volatile, right?
Yeah.
Or when it experiences higher volatility, when we're going through market turmoil like we are right now, you're going to panic, right?
Hmm.
And so I want our viewers to really understand that it's not just about the S&P 500. It is, if you told me you got 20, 30 years and you're just going to power money into some ETF and you're just going to dollar cost average for the next 20, 30 years, and that's what you're going to do, fine. I don't,
Hmm.
S&P, I think the American market will be absolutely fine in 20, 30 years. Okay. But if you need the money within 5 years, even up to 10 years, then I think you need to be well diversified. But I'm going to ask you a question. You can invest in multi-asset funds. So they are available. Even on Vanguard, you will have portfolios that will have a mixture of just bonds and equities. So you might
That are
have like
pre-built.
80/20,
Yep.
that pre-built, yeah, the
Pre-built.
80
Yep.
20,
Yep.
80 20, 60 40.
Yep.
They may even have something called a target retirement fund, which I think they're okay, but it depends on what you're trying to
Yeah.
achieve,
Yeah. Yep.
which will change its asset allocation naturally for you as you approach
Yep.
retirement. And it doesn't have to be retirement. It could be approaching when you need the money. So you could just use the
Yep.
date as your
Yep.
time frame. If you're using platforms like AJ Bell or Hargreaves Lansdown, then you can buy the multi-asset funds, and it will normally have a clue in its name. So it will say something like cautious or balanced or
Hmm.
adventurous, and it could be a bit more detailed, like moderately cautious or
Yeah. Yeah.
moderately
Yep.
adventurous. And often that will give you an inclination as to the risk of that portfolio. So they do exist. It's just most people don't go to those things. And I think you've heard the no one head when you say people go towards things that are less costly. And so ETFs and things that are dealt on exchanges are probably the most popular amongst a
Hmm.
society right now. So using platforms that are no commission, like Trading 212, which I absolutely love, by the way. These are great platforms, but you're probably not going to find these unitized kind of assets on those platforms,
Yep.
which is a challenge. And I think that's what we can do as people who have been in the game for quite a while. Our
Yep.
professionals have that experience to actually guide people to actually, even though they are low cost, sometimes things are a bit more expensive for a reason. And it's about whether you're paying a fair price
Yeah.
for the
Yep.
service that you are getting.
Yep.
So if you still want to DIY, then what my guidance would be, go and look at the way those portfolios are structured. So if it's an 80/20 or if it's a target retirement fund, look at the mix of assets and you can try and
Replicate it.
that
Yeah.
replicate it, yeah.
Yeah.
But it's not easy to do. And the final thing I would say though is replication may work when you're starting off, but remember these guys rebalance to keep that allocation. So you've got to
Yeah.
learn how to do that as well.
Yeah. You mentioned something earlier that it does ring a bell with me, and this is one of my internal battles eternally for the past 5 years. Is I'm kind of in the camp of these group of people, but like obviously you're right. A lot of people who talk about investing online will automatically just go S&P 500, S&P 500, S&P 500, and my problem is, and I feel like this often, I feel like I'm in an echo chamber where it's like the same thing gets said over and over and over and over again. And I think what we miss sometimes is we miss a lot of the nuance. And I say this, and I'm always very conscious that I don't want it to be kind of like to come off as though other people don't know what they're talking about. But it's like the S&P 500 is great. It's fantastic. All
yeah,
right. It's a great index, but it's not the one bullet to solve all the problems.
yeah,
And
no,
this is where the boring stuff that we've already spoken about, goals, timeline, attitude to risk, capacity for loss, that dictates how you actually build it. And I feel like because YouTube and social media is an echo chamber of S&P 500, ETF or index fund, that seems to be the default thing that
yeah.
everybody goes for. And I feel like we need to kind of break out of that a little bit. It's just very, very difficult to do when every Tom, Dick, and Harry online is talking about this one thing.
Yeah, it's extremely difficult, and as I said, it to me, I'm a bit more maybe not controversial, but less politically correct. I just think, I just think some of it's nonsense, and I think sometimes I can tell when someone has just heard something from someone else and they're just regurgitating it.
Bro,
I-
that is my biggest thing right now. And
yeah,
and and this and I keep saying to people, I say, like, unfortunately with things like ChatGPT, you can ask it, what are the best 5 tips to invest right now? And I'm seeing people where they're making videos and it sounds like a ChatGPT
yeah,
script.
yeah. I know it is.
There's
I can tell.
there
Yeah,
there's no detail, there's no nuance. It's just
yeah,
talking points.
yeah,
I saw one today and I'm just like, okay, there's
yeah,
no nuance in this at all. So it's
yeah.
like if you probe, and I just want people to kind of just be aware of that, because the things that we're talking about here in terms of how you construct the portfolio, rebalancing, I want to ask you about that, because that's something that a lot of people are not going to understand. That
Mm,
if you've got a portfolio where your appetite to your attitude to risk and your passive loss says, okay, you should have 60% in equities, maybe 20% in bonds, and then 20% in either commercial property or whatever it might be. Or let's
mhm,
say, let's keep it simple, 60% in equities, 40% in bonds. As your portfolio grows, your equity weighting is going to shift,
yeah,
right?
yeah.
So the rebalancing act is actually, how do you get it back into that 60% weighting? What would be your tips on how people can actually do that, given the tools and the providers that they have, if they're using something like a Vanguard, for example?
So if it's a Vanguard, then and you've got the 60-40 split, they should really do it for you, right?
Hmm.
Now that's if that's the only thing you have. And I think the challenge is
Yep.
a lot of people don't just have one fund.
Hmm.
And I've done sessions with people where they've come into me and I've looked at their portfolio and it's just got a
They got
whole
seven
bunch
ETFs.
because I know and it's the same
Yeah.
thing. Yeah, it's
Yeah.
like
Yeah.
you could have done this with like two funds.
Yeah.
But yes, look, if it's a Vanguard 60-40, 80-20, whatever it is, even if it's a target retirement fund, they should be doing the rebalancing for you, right?
But what if they don't have the target retirement fund? So let's just say they bought like an S&P 500 ETF, for example, and then they
Mm.
have looked around at some of the bond options and just gone, okay, 60-40, boom.
Got you. So in that case, then it's simply looking at your allocation, actually looking to see if it's worth the value. So if it's worth 10 grand,
Hmm.
and obviously in theory, then your equity section should be 6 grand and your bond section
Yep.
should be 4 grand. But if you had done this 2 years ago, clearly your portfolio, especially the equity section, has gone up quite a bit to the point
Yep.
where it's probably 70-30 now. Now,
Yep.
when you look at that split, you were overexposed, and that portfolio does not actually match your objectives, your time frame, your risk tolerance. And so, in this situation, you need to sell down the equity portion and you need to buy back some bonds.
Hmm.
And at first, that might be like, oh man, I'm selling my winners. Some people say things, I'm selling my winners, but
Yeah.
it's
Yeah.
okay, right? Remember, you're trying to keep the mandate, the portfolio optimized for your mandate.
Yeah.
And actually, by selling, you are taking profits, right? And the name of this game is to sell high, buy low and sell high. So actually,
Sell
that's what
high.
you're
Yeah.
doing.
Yeah.
Because if bonds have gone down, because the portfolio may change because bonds have gone down as well, right?
Hmm.
So actually, you might be taking some profits from equities and actually buying bonds cheaper, and that's why we rebalance. In my opinion, I think rebalancing, well, from professionally, we rebalance or look to rebalance potentially at least every quarter, kind of
Hmm.
thing. But it also depends on how much out of whack
Yeah. Yeah. You are. Yeah.
the portfolio is.
Yeah.
Yeah,
Where does personal greed come into this? Because that's always the biggest factor that I see, right? Because
yeah,
like you, I do coaching with people,
yeah,
and it's like, oh, I don't want to sell this because it might go a little bit higher. And I'm like,
yeah, yeah.
but it could drop tomorrow. And the amount of people that I've spoken to are like, oh my god, Pete, oh my god.
Yeah.
Like, what's going on?
What's
I've
going
lost
on?
this much, and I'm like, okay, but did you even think about maybe taking a little bit off the table
Yeah.
to
Yeah.
protect yourself? And it's like, no, because I thought this is gonna go up forever, and it's like it never does.
Never does. Well, Pete, look, as I said, the Jackson that's today is 5 years. I think it's been 5 years, 6 years, 6 years. I think it's 2019. It's 6 years more wiser than Jack's that was in his 20s. And one of the things that I've noticed through the years is invest. People think investing is all about picking the best stocks. You can go and do a whole discounted cash flow modeling and do a whole bunch of stuff. And people think that's what makes a great investor. And I've come to the conclusion that what makes a great investor, and also what makes a bad investor, is 90% our psychology, our psyche, our behavioral
One
biases.
hundred percent. I'm with you on that. One
Um,
hundred percent.
I'm so certain of it. And so, yes, greed and fear, those two are extremely powerful. These are powerful. And actually, I believe it was John Maynard Keynes, or Keynes, however you want to pronounce his name, that said that most of the fluctuations in the stock market are down to our animal spirits,
Okay.
right? So that's the terminology he uses, animal spirits. And what do animals normally want to do? They either want to kill or run away, right? Fight or
Yeah, yeah,
flight. Usually
yeah, yeah,
it's one of those things.
yeah.
And so our animal spirits causes us to be greedy when things are going up. And scared when things are going down, which goes back to another phrase. I think it might be Warren Buffett that said, "Is the stock market is the only place when things are on sale that people run away from it." Right?
Yeah,
But it's
yeah,
our
yeah.
animal spirits. What is our so-called animal spirits? Because we don't like pain. I posted something yesterday on my Instagram and I said, if you want to do well in the stock market, you have to overcome your own human bias, right?
Yes.
Because we're naturally built to run away from pain,
Yeah,
right?
yeah, yeah.
Well, pain
Yep.
tells us that something's wrong, something's not right. So let me fix this issue, or first of all, let me take some action. So we always want to do something, and
Mm-hmm.
sometimes not taking any action is a form of action, is a decision,
Yep.
right?
Yep. Yep.
So sometimes just leave it alone, don't do anything, right? Turn off Bloomberg or whoever, or
Yep.
CNBC or whoever you're watching, kind of
Yep.
thing. So yes, I would say majority of the bad decision making and good decision making, it comes down to your ability to manage your own emotions and be very aware of the animal spirits. And
Yep.
if you're selling because it's going down, you think it's going to go down forever, it always feels different. It always feels like it's never going to end. It always feels like you're going to lose money, but you're not
Yeah.
losing anything. You haven't lost anything.
Yeah.
It's all a paper gain or paper
Yeah.
loss.
It's amazing you said that because I'm in 100% agreement with you. I did a live this week on Instagram, and I said like one of the things that we have to learn to do, and I still struggle with this to a certain extent, is being really dispassionate around the decisions you make when it comes to investing. And I gave this example.
Mm.
I don't like Trump. So naturally, because I don't agree with his politics, I'm hypercritical of what he does.
Yeah.
But at the same time, we're now in a situation where at that point in time, the heat map was just red. It's very, very easy to then criticize and be like, well, he did this. But on the flip side to that, I'm fully aware that when everything's going great, I'm like, fantastic. So how do I take the emotion out of the fact that, okay, I don't like this guy. I don't like the decision that he's making. I don't like the impact of this. But what's the dispassionate way of looking at this in terms of, is there an opportunity? Should I do something? Should I not do something?
Mm.
It's so jarring sometimes to be able to take that stance.
Well, Peter, we have to be honest with ourselves and say we're always going to be human.
Hmm.
We're always going to have these emotions. In fact, that's what makes us different from robots, right?
Hmm.
We have a soul. We have a specific type of brain that tells us to protect ourselves and that kind of stuff. So I think firstly we have to be honest with ourselves to say, hey, we are human and we're always going to feel a type of way, and we are never, for majority of us, we're never going to make the most rational decisions,
True. Yeah.
and we have to be honest about that kind of thing. And if we're honest about that, then we can adjust the way we invest. And it's not just about investing; it's a lot of life decisions, really and truly,
Yeah.
and decision making. But one of the things that you can do is, for example, is have a system, or automation is one of those things, right? If you're a natural spender, and you say to yourself, I'm going to find a way to save money every month, I'm going to move money to a savings account, you're not going to do it, right? Because you're a natural spender, you want to do it. But hey, if you have an automatic direct debit that moves money from one account to another without you having to make the decision, chances are you will get it done. The flip side is you might be a natural saver like I am, right? And for that reason, I might save too much, right? And I might not actually enjoy my money. So one of the things that I had to do in terms of decision making, or removing having to make a decision, is that I automate money to go into a fund pot where I have a guilt-free spending account that I could just use it for vibes and enjoy life.
Yeah, yeah,
Do you understand?
yeah,
So we want to actually eliminate as many decisions that we have to make because
yeah,
if we're left to make our own decisions, we will just self-sabotage. And that's what a lot of
yeah,
people do in the stock market, they self-sabotage. And that's why even the S&P 500 we've been speaking about has been going up for the past 100 years, obviously ups and downs, but people lose money. Why is that?
yeah,
It's because of the animal spirits and bad
yeah,
decision
yeah,
making.
yeah. So, what's your view now on the global outlook of investing moving forward? Because I think we're in a very, very interesting point at this point in time, and the long-term effects, if there will be any, of this course of action with Trump is perhaps a strengthening of China's position in the world as a trading partner. I mean, you're already hearing Canada and China thinking about a free trade agreement. I think if we carry on along this road without an off ramp, potentially Europe is going to be looking at China as a potential trading partner. The Americans don't want that. That's detrimental to them.
Yeah, yeah,
So I think, is there still an argument for looking at globally diversified portfolios? We know that Europe has done particularly well. The first quarter of this year outperformed the US because
yeah.
of all the other stuff that he's been doing around NATO and defense and all that kind of stuff. What's your view in house?
My view is to always remain diversified. I think diversification. I think if you've been in this game for a while, or you've learned about it, you've studied it, we always talk about diversification is a big part
Hmm.
of investing. And sometimes we say, but we don't actually act like we believe it.
Yeah.
And so we will say, hey, I own the S&P 500, so I'm more diversified. But as we've just spoken about a few minutes ago, 30 or 40% of it now is the Magnificent Seven,
Hmm.
and so on and so forth. So you're not really diversified. And remember, diversification is not just by stock, it's also regionally, which is what we're
Regions.
talking about.
Yeah.
And so we believe in diversification. We believe that diversification is a way to manage risk. We also believe that often when you look at the best performers in one year, often in terms of region, often they don't perform as well as other regions in next year, right?
Hmm.
Let's look at Japan. Japan
Yeah.
was
Yeah. Yeah.
horrible
Yeah.
for quite a while, but I think they look quite attractive for long term.
Yeah.
Investing at the moment, we've got emerging markets, obviously like a little bit shaky, but having a bit of emerging markets in your portfolio adds a different flavor to your portfolio. And Europe, people for Europe, whether they call it the dinosaurs or whatever people want to call it, but as you said, it's outperformed, and there's still some very good companies in Europe, for example,
Hmm.
right? And this is not an investment recommendation, but for example, and this is personal, I like ASML. I think ASML
Hmm.
is a great stock for the long term. Um, so yeah, I think it's always important to diversify globally, and I'm going to say something that people won't like. Even the
Go on.
UK,
Go on.
even the UK
Go on.
is not that bad. Even the, but when I say the UK, I think you have to be a stock picker. I personally think you have to look
Yeah,
for
you know
opportunities.
what, the UK is an interesting one because it's like, I feel like if I speak to people, it is true, we've got a ton. If we looked at it objectively, there are a ton of companies in the UK that are undervalued right now, absolute bargain.
Yeah,
But I think because of everything that's happening with the government and the political system, there just isn't that confidence there,
yeah, yeah.
and I think that's one of the main things.
Yeah, and that's why I say it really depends on your style of investing, or your time frame, and that kind of stuff. Whether you are a value investor, if you are a value investor, then you might be seeing quite a lot of value in some UK companies and investment
Hmm.
trusts as well, which is a sector that's been really shaken over the past few years. But one of the reason why I've mentioned the UK is because again, And I think what we can do, especially people of us, people like us who do come from the professional background, is to really hone in on the education, because a lot of people don't understand when you invest in US stocks, you're not just investing in that company, you're also investing in a dollar, right?
Yeah.
There is currency risk. And I don't think a lot of people understand that currency risk is a real thing, and it
Yeah.
actually holds a proportion of your overall returns,
You
kind
returns.
of
Yeah.
thing.
Yeah. Yeah.
So and most retail investors are not going to hedge their portfolio like multi-asset funds, where we use derivatives like forwards and
Hmm.
stuff like that. And that's why I mentioned sometimes having a tiny bit of a home bias. If you were a stock picker, is you can find some companies where you're not taking any currency
Currency
risk,
risk.
and
Yeah.
that kind of
Yeah.
stuff. So that's why I mentioned it. Like that's an opportunity.
Yeah.
But when I look at the globe, I do like Europe. I do like particularly Japan. But look, let's be honest. The US is a US. It's a powerhouse. It's got amazing companies that have long term growth, and so we shouldn't boycott the US. It will probably still make a big proportion of most people's portfolios.
Yeah.
But I do think to an extent you have to definitely consider. I personally don't think you should have a 70-30 or portfolio, as in 70 in the US and 30. And if you are, then I think you have to go even deeper within the region to diversify.
Yeah. Yeah.
Right?
Yeah.
Yeah. So you
Yeah.
can't just be I'm in the US and I'm only in tech. then
Yeah. Yeah.
then
Yeah. But that's mostly. I mean, look, most of the portfolios that you'll find and funds that you'll find, they won't. I've never seen one with 70% in exposure to the US, but certainly 50, 60. But still, the tech sector is still,
so
in
heavy.
most cases, so heavy because of the likes of the Magnificent Seven or Magnificent
Yeah.
Eight,
Yeah.
because of the way they performed. And what has been interesting to see is how much those companies have been hammered. I mean, look, I've been
Even the
looking at
big
stuff
ones.
today.
Yeah. Mm.
Yeah, I mean, look, I've been looking at stuff today thinking, right, so China comes back with 125% tariffs. I mean, if that, if Apple do not get an exclusion or an exemption of some kind
It's-
granted by Trump,
yeah.
they are going to get absolutely hammered.
Yeah.
And if
Yeah.
they don't get an exception, what does it mean? It's hugely inflationary for. I mean, we're going to be looking at £2,000 iPhones. I'm not
Yeah.
buying one of those.
Yes. Yes.
Absolutely not.
Yeah. Yeah. It's
Or they're
nuts.
going to have to eat part of the tariff, and
Yeah.
that's not going to happen because capitalism. They've got
Yeah.
responsibilities to their
Yeah.
shareholders to
Shit. Yeah.
provide a return. So it's absolutely crazy.
It's nuts. It's scary times still. I think when we really look at what's happening, it's like two big heavyweights just going at it, and it's
Go.
not pleasant to watch, because those two heavyweights are our family members. Let's call it like, right. It's always like, so
Yeah.
it hurts you. Um, so yeah, I do think it's very important to diversify a portfolio. I would say in the first 10 years of my investment journey, diversification was less of a priority for me, because I was young and I was still learning. Right now, I preach diversification like never before, because I have seen the market fluctuate quite a lot. I mean, 2018 in December, I saw a big dip. We had the lockdowns, and
Hmm.
that was intense in itself. 2022, gosh, that was a horrible year, right?
Hmm.
And so I remember telling one of my mates that 2022 is probably one of the best things that has happened to me as a retail investor, or as an individual
Mm.
investor, because I got to experience what it's like to go for a whole year down, right? And right,
And you got
that
to hold your patience. You
you
got to
got a
look at it
whole,
and think, please. Yeah.
and I think, and I know retail investors don't like to hear this, but one of the worst things that can happen to a gambler is when they go to the casino and they actually
And win.
win,
Hmm.
right? Sometimes the best thing to happen to him or her is for them to lose and to get the heck out of there, or whether casinos or gambling, or to adjust some things. Okay.
Yeah.
So for me, I think actually going through that experience reminds me of the power of diversification and making sure you spread your risk across different regions, across different stocks, large cap, small cap, mid cap, different sectors, industrials, materials, REITs, large cap equities, whatever. Just have a nice rounded portfolio, because in the long term, corporate profits, assets will go up in value. And to be honest, if you were not diversified and you were again just in the S&P 500 for the next 30 years, again, I do believe you will be absolutely fine. But we're human beings and we look at our portfolios and our portfolios are volatile. And so we want a smoother journey there to our
Yeah.
goals.
I love the analogy you used about the casino there because I think you're spot on because it also feeds into our own biases and our own behavioral makeup as well. I mean, it's very, very easy, especially, and this is something that I see in a lot of people who just begin, put money in the S&P 500 or something, and it goes up, and you get that confirmation bias immediately, right?
Yeah,
Yes, I've
yeah,
made the right choice. Or
yeah, yeah,
someone picks Tesla, and it's like, oh yeah, Tesla's gone up, and it's like, yes, I've made the right decision,
yeah,
and it's like it could have just been luck.
yeah.
It could have
Mostly
just
it
been
is.
most of the time, yeah,
Mostly it is.
most of the
Yeah,
time it is.
yeah,
Most of the time it is. But I think that's a really powerful kind of like dynamic that we have to be aware of,
yeah,
like the confirmation bias and all the other biases that we have as investors, because those are the kind of the gremlins on our back that drive the decision making. It's that little thing of like, you need to get out right now
yeah.
because
Loss
you know
of
you've worked hard.
or yeah,
You've worked hard for that money. You just lost 500 quid.
yeah, yeah,
What,
yeah,
imagine what that could do for you right now. You know,
yeah.
we have to managing that is so difficult, and
It's
but it's an
difficult.
important part.
I would encourage everybody, all the listeners, to really spend some time. If you really want to be more of an active investor, or you really want to power your cash into assets, and it's a great, look, the stock market is a powerful wealth creation tool. It's very powerful, and so it's a great place to be for the long term. And if you really want to do that, I would also encourage you just to really learn about our behavioral biases. You'd be
Hmm.
shocked how many there are. By the way, there's so many
Yeah,
different terminologies to explain whether it's regret aversion, whether it's confirmation bias, whether it's
yeah,
loss aversion, whether it's the endowment effect. There's so many
yeah,
psychological explanations as to why we're not
yeah,
rational, right?
yeah, yeah,
And when you start to learn them, you become a much better investor, which I believe I'm a much better investor today than I was when I was younger. Even though when I was younger, I was getting some really crazy returns. I'm humble enough to say, even though I thought I was a great investor, a lot of it was luck kind of
yeah,
thing. And even judging who's a better investor than another, younger jacks got better returns. Older
mm,
jacks gets the best returns from my objectives and risk and tolerance.
yeah,
Do you understand? So, and I
yeah,
think that's extremely important. The bias thing is important, and it was show. And when you start learning about it, it will show up in different areas of your life. Like I'm a big football fan. I love football. I've got lots of football chats, and
yeah.
now when I'm having football conversations, you can literally see the biases on people's faces. Like they don't realize that they've got recency bias, they've got
Yeah.
confirmation bias. They don't know, but I can see it clearly because I've studied it, and it's like I know what you're doing. It's okay. You don't even know it, but I
Yeah.
understand.
I won't ask you about the Onana situation though,
Oh,
like,
let's not
dude,
get there. Yeah, yeah. I wish him the best, but it's not going well. My team
I
have
know,
been
mate.
struggling, man. Yeah,
Yeah, I'm with you on that, mate. Because I watched it and I was like, just clear the ball, please. And it's like 10 seconds later, it's like, come on, at the end
yeah,
of it. It's
yeah,
absolutely mad. But anyway, I've got one last question for you before we go to kind of like the chat. There is still a little bit of a fear, possible recessionary fears in the US. We don't know what's going to happen, but if you do, you think that is going to be a probability this year? Obviously, depending on what Donald Trump does, whether or not there are negotiations, whether he has an off ramp or not. Nobody
yeah,
wants to see the US go into recession because obviously it's going to hurt everybody else.
yeah. When the US
What
sneezes,
are you kind of
everyone
hearing?
catches a cold. That's what they say. When
Hmm.
the US sneezes, everyone catches a cold. So what I'm seeing is before we came into 2025, when we look at like economic forecasts from different providers, my providers, etc., there was still a chance of a recession. I think that's really important for people to understand. Coming into this year, there was still already, glimpses of potential recession, but it was low.
Hmm.
Somewhat 5%, somewhat 10%, etc. What I'm seeing now is the forecasts have ramped up the likelihood of a recession from that 5-10% to that 20%.
Yeah.
So it's still somewhat low, if you want to call it. So it's not like 50% chance of a recession, but
Hmm.
it's a real possibility, and that's something that we need to be very much aware of. And again, it comes down to your definition of a recession as well, because the
Yeah. True.
technical definition is 6 months of negative growth or two
Hmm.
quarters of negative growth. And I think the important thing is when it comes to like recessions or even markets is not just well, one, how deep it is, right? So is it a deep recession or is it just a little
Quick
pullback
rebound.
and quick rebound, and how long it is? So how deep it is and how long it
Yeah.
is as well. So
Yeah.
um, if we do go into a recession, I think if you are a long term investor, there's still nothing to worry about. Again, hey, in my very humble opinion and factually as well, if you are still in the accumulation phase and you're still accumulating assets and you're privileged enough to still have an income, it is a fantastic thing for you as an investor. And I say that with empathy for people because people lose their jobs. So I'm talking purely from the
Yeah.
investment standpoint that actually recessions and stock market dips are fantastic. And actually, and again, I know it goes against our psyche, but the stock market going down and staying down for even a while is a fantastic thing for accumulators because you're
Yeah.
buying more shares at lower
At lower
prices.
close. Yeah.
So that's nothing to worry about as long as you have a portfolio that actually matches. I'm going to say, I keep saying it this episode, that matches your objectives, your time frame risk. As long as you've got that portfolio, you've got an income coming in, accumulating those assets at a cheaper price is a fantastic thing. I was telling someone the other day, P, that when we look at a stock market, or a stock market chart, even a stock chart, people want to see a stock chart that starts from left to right and it goes like this and it's on the way up,
Hmm.
right? It will always be ziggy because it's not
Yeah.
zigzaggy because it's
Yeah.
there's ups and downs. But I was trying to explain something to someone the other day that actually, you see that chart that looks like the one that you will make the most money if
Hmm.
a dollar cost averaging. But
Hmm.
I present to you that a chart that looks like this and it's down and it's down and it's down and it's down and it's down, it just goes up a bit, can actually provide you with a better return than one
Yeah.
that's just been going up on a straight line.
Yeah.
That's because
Yeah.
when you're dollar cost averaging or pound cost averaging, when you keep buying, you're buying at such a low price. It only takes
Yeah.
a bit of a move for you to really get
Yeah.
a return.
Yeah.
Whereas when you're averaging in and it's going up, remember you're still buying it at higher prices.
Yeah.
So that's something
Yeah.
that a lot of people don't see as well.
Yeah. Yeah.
Um, but yes, there's the to answer your question, there was already a risk of recession going into this year. And now there's a higher risk of
There's
recession
a
because of
recession.
all that's
Yeah.
going on.
Yeah.
But it's still not like high, I would say. It's still not like above 30%.
Yeah. So what I typically say to people is, when you're faced with potential for a recession globally, it's really, really important to ensure that, you are kind of positioned in the right place. So recessionary periods are not necessarily going to be great for maybe tech or growth stocks,
Mhm.
but for things like, energy, food, consumables,
So,
those types of things,
yeah,
they're essential to our existence. Everyone needs food, everyone needs shelter, everyone needs energy. So
yeah,
those are often the kind of stocks that tend to be a little bit more stable
yeah,
in a recessionary period because they're catering to our everyday needs and stuff. And I think that's a really important point to kind of like put across just for everyone who's actually watching in terms of the way to think about this, in opposed to, okay, it happens, panic. It's about making sure that you're positioned in the portfolios now to have exposure to those kind of companies so that you don't have to try and undo something a little bit later on.
absolutely, absolutely. There are always sectors, asset classes that will do better, or fare better, in the recessionary environment. So you mentioned consumer staples, absolutely.
Hmm.
So as you said, everyone needs their Vaseline, their cream. So
Yeah.
companies like Unilever, again, these are not recommendations, but I'm just mentioning them. Companies like Unilever, L'Oreal, these companies, for example, will probably still be okay. Um, Again, it does depend on how deep the recession is, because again, when recessions are really bad, everyone gets hit anyway. I
Yeah.
think what's even more important is getting your mind ready to understand what recession is and understanding that it doesn't last forever.
Hmm.
And so if it does happen, and if it is deeper than we thought it would be, then don't be reactive then. So you
Yeah.
can position yourself now, and like I was saying, even before all these Trump tariffs, you could have positioned yourself a bit better and that kind of
Yeah.
stuff. It is my encouragement for people to always have a bit of cash, even within their portfolios, right? So this is aside from having your emergency fund. That's number one. Have your
Hmm.
emergency fund there,
Yeah.
but you can
Yeah.
always have some dry powder as well, because opportunities always present themselves, and when opportunities present themselves, you want to be able to capture them. So having some
Yeah.
cash is fine as well. So you spoke about sectors within equities, but also other asset classes as well.
Hmm.
Probably, I wouldn't say now is the best time in my opinion. But you can, I mean, you can. But even like you said, gold. Gold
Hmm.
is an asset that often does well
Yep. In
during
recessionary periods.
when recession when
Any
anything goes wrong,
yeah, any the uncertainty, yeah, for
any
sure.
uncertainty,
Yeah,
gold does well. So
yeah,
there's always money to be made in
yeah,
assets.
yeah. Good. All right, let me just have a look and see what we've got in the chat. So if you do have any questions at this point and you've dialed in, now will be a good time to ask your questions, and we'll try and answer them. Just be mindful, we can't give you any direct financial advice because we're not your financial advisors, but we could hopefully give you an answer that might give you a little bit of guidance. So let me just see what we have here in the chat with some questions. I think there's a little bit of a delay on the live as well for some reason. I'm sure it's like a minute or so, a 30-second delay. So let's take our time with this. I'm just going to read some of the comments actually. Someone's just saying here the best method to play the market is not to play the market. Sit on the side, save money, wait until there is stability in the US. I think there's definitely some truth because it comes back to time in the market. When's the bottom, Pete? I don't know.
Nobody knows. Nobody knows. And if you're trying to time the market, you're trying to do two things. It's not timing the market is not one decision. It's actually two decisions. You need to know when to come out and then when to go
Hmm.
back in.
Hmm.
And that you might get one right, but to get two right is extremely difficult. Um,
Yeah. Someone's just saying here bonds have spoken in the US, hence the 90-day hold. It was so interesting. Oh, mate, listen.
the bond, so we call it bond vigilantes. That's what
Hmm.
someone said the other day.
Yeah.
Yeah, the US Treasury spoke volumes.
Yeah, absolutely. It's one of those things where it's kind of like you have to admire him to a certain extent that he does have balls of steel.
He has
J-
audacity. He's audacious.
Just, oh my God, like, and then when he was like, now's a good time to buy. And then,
I think that they're talking about some potential insider dealing stuff. I think I saw that come across my
yeah,
page.
I've seen that as well because would he be stupid enough to do that?
Now,
I don't
this,
know.
by the way, I'm not speaking as a professional today. I'm speaking as Jax. Would he be? I wouldn't put anything past him. And
Yeah,
I'm not saying he's done it. Him specifically, by the way.
but
I don't know.
his circle
Yeah,
for sure.
you
Yeah.
know, I mean, when it comes to politicians and even business people and how the market works, sometimes I do have a bit of a I can be suspicious. I
Hmm.
can be suspicious because surely you might have some inclination as to what is possibly going to happen.
Yeah, I mean,
So
if you're in his inner circle or you're
yeah,
around it, you're going to know
yeah,
because
yeah,
you'll have an inkling of he's thinking of doing this. Like you, we know that the all of the politicians they buy individual stocks. I think it was Marjorie Taylor Greene bought like $1.5 million worth of stock, and she bought in Apple and so on. And there was maybe five or six stocks or so that she bought literally the day before. And it's like, is it a coincidence
yeah,
that she's bought
yeah,
$1.5 million worth of stock in certain companies, and then the following day there's a tweet that goes out, and all of a sudden, boom, 7%.
yeah.
Like,
Do you know what like you can never really prove it, and I think that's the thing.
I know that's the whole point. You can't
Yeah,
prove it.
you can't prove it.
Yeah, yeah,
You can't prove whether they knew or not. So
yeah.
yeah,
Russell's asking here, how much? I don't know the answer to this because I don't really know. I mean, because you're looking at big players and retail investors here. He's asking how much market movement comes from retail investors. I mean, against institutional money, retail investors is still small. It's
there's some
not as
small.
small as it used to be, but it's nowhere in comparison to the size of
Yeah, you're fighting again. Not
financial
fighting. You're fighting.
institutions.
Pension funds are the biggest, I believe. Then you got
Yeah,
several wealth funds. They're huge. Yeah, so retail will.
minuscule.
I've actually come across it before, but I can't remember on the top of my head. It also depends on which asset class you're referring to as well.
Yeah,
Some asset classes are held widely by retail. Other asset
yeah,
classes, like small caps are held by retail. Whereas if you're dealing with like gilts or treasuries, that's held by many pension funds
yeah,
and insurance companies and endowment funds and stuff like that. So it's still quite small, and retail does don't move the market as much as like the big institutional money.
the big boys. Yeah, absolutely. Cool, dude. We appreciate you doing this. Why don't you tell everyone how to basically how to find you? Because I know you took a bit of a hiatus from like Instagram, YouTube,
Yeah,
all this
yeah,
kind of
yeah.
stuff. Because you'd had a great period where you were sharing obviously the progress that you were making building your portfolio, and I always found that really really interesting because it gave
Really.
people an insight into the fact that it's just about the habit of putting
Be
money in
consistent.
and being consistent to
Yeah.
actually grow something of value.
Yeah, so I mean, and also life happened. I got married, bought a
Got
house,
married.
and but yeah, by the time
Yeah,
I knew it, it's like 2 years had gone by. I just
yeah,
couldn't keep. And work was just becoming really busy. And look, because I am a professional, sometimes I have to really be mindful of what I say, etc., etc.
yeah,
Because as I said, today I'm speaking as Jax. I'm not speaking as Jax, the professional. I'm just speaking as
yeah,
Jax, Pete's friend.
yeah.
And so, yes, I do have Jax Financial. That's where people can find me. JAX Financial, predominantly on Instagram. I am very much looking to make a comeback to YouTube um, this year. So I am on YouTube. It's Jax Financial. I'm not sure if I've got any videos up. I might have one or two, but I will be making a comeback. So if you want to follow me in preparation, then that will be fantastic. But right now, I'm mostly on Instagram.
Cool. I'll leave links in like the description and the title, tagging the other channel and stuff like that here. But when I was thinking about who I could ask to do this with, you're the first person that came to mind because I know that you're also in the industry with qualifications, and
Yeah.
we could have a really good conversation about this at a kind of just like a normal kind of like level for
Absolutely.
people to
And I
kind of
also, yeah, I always tell
listen to.
people, yeah, while I've got the qualifications, a professional background, I am also mostly for the people. I'm a
Yeah,
retail investor first,
yeah,
and so that's what I like to use my professional background for my personal life, even more than
yeah,
anything, and helping the everyday person.
yeah,
That's another conversation for another day. But look, when you grow up from poor background and you're exposed to information and that kind of stuff, I think it's very important that we bring it to the people. And also, it's important that people like us are having these conversations because
certainly
again,
for my background, for
yes,
sure, 100%. Yeah,
there's a lot of information online, but a lot of it is incomplete, and a lot of it
yeah,
lacks that kind of real, thing behind it.
yeah. I love the way you say incomplete because sometimes, mate, I see some things and my blood just boils and I'm just
I'm,
like,
I'm,
this
I'm,
is
I'm being kind.
garbage.
I'm being kind.
Oh my days. Oh my days.
There's
But I
there's
think,
a lot of garbage out there. There is.
yeah,
There
but
is.
I think you're
There is.
right. It's like, especially from people with our background. I mean, I didn't start learning about investments until I was like 32. And I'm like, hang on a second.
Yeah.
People are putting money where and it's doing what? And then
Yeah.
I'm sitting in meetings with people, then they're complaining about making 50 grand in profit a year. And I'm like, are you mad?
Yeah. Yeah. Yeah.
Like, you've
It's
made
nuts.
50 grand by doing nothing. Like,
Yeah. Yeah.
excuse me?
Yeah.
It's
For
crazy.
me is when I was working, and one of my first jobs or first tasks within my role when I worked in the back office was I had to go through our client portfolios, and I had to just make sure that the income generated from their assets was enough to meet their targets. So
Hmm.
uh, John and Mrs. Smith want £2,000 a month of
Hmm.
income every month. Have we hit that target? Do we need to sell some assets to match that income target? And I was like, wait, so hold on, these people are, how do they make this income? So this is just dividends, or this is just
Yeah.
interest. This is not, we're not actually having to sell assets. They're living off the natural income. And sometimes
Hmm.
they'll message or email me, be like, oh yeah, we're looking to go on holiday. We just want some income from the portfolio. Can you send us? I'm like, gosh, people are really living off assets.
Yeah.
And for
Yep.
someone who grew up in an environment where that wasn't part of the conversation, it was fascinating. And it was
Yeah.
from then I said, yeah, I need to build a portfolio, so I can make some of this. They call it passive income now. Back then, that wasn't
Yeah.
the phrase. It wasn't passive
Yeah.
income.
Yeah.
It's called
Yep.
natural income, really, or
Yep.
portfolio income. But yeah, fantastic, fantastic.
Yeah. Good man. All right. Cheers for doing this with me, and thank you to everyone who's attended this evening. I've not done one of these for a while. Like I said, I might try and do another one, but we do have a time difference now, and the time difference is a little bit of a killer sometimes. But thank you so much for watching. The thing that you can do for me if you really enjoyed this is make sure you smash the like button. It just means that the algorithm will push it to other people who might find this really, really interesting. And if you're finding me for the first time, feel free to consider smashing not just the like button, but also the subscribe button as well. But I appreciate you and thank you so much, Jax. Have a good one, mate. And Sir
Pete, it's
Writes,
always a
this is from
pleasure.
me as
Always a
well.
pleasure. Take care. Bye
Cheers,
bye.
dude. Catch you later. Cheers, mate.